1.3, Miscellaneous Policy, Part 1. People, this miscellaneous policy is a long section, so we divided it in two parts. So let's look at Part 1. So the definition of a miscellaneous policy. It's a contract in terms of which an insurer, in return for a premium, undertakes to provide policy benefits if an event contemplated in the contract as a risk relating to any matter not otherwise defined in this section occurs, and includes a reinsurance policy in respect of such a policy. So it's the same as uh, all the other policies. There's always will be a contract in terms of which an insurer, in return for a premium which the insurer will pay, the insurer will undertake to provide policy benefits if an event which is contemplated in the contract as a risk relating to any matter of those risks, but not otherwise defined in this section, occurs, and it includes a reinsurance policy in respect of such a policy. If you remember the previous one, clause 1.2, there I said contract as a risk relating to any matter which included defined in that section. But this section is about commercial lines as well. There's a lot of them, so that excludes the commercial lines. Right, so always there's a contract between the insurer and the insured. The insurer will provide policy benefits for the risks mentioned inside that policy, but for a premium which the insured will have to pay. So please take note commercial lines. In some instances, we will briefly refer under miscellaneous policies to commercial line product. This will not be tested in the personal lines exam. However, it will broaden your knowledge base when confronted by clients. So you are going to write exams on personal lines, but we will not ask questions about commercial lines. It's just there to give you more information, background information. So should you sit with clients and they've got different kinds of questions, at least you've got some more knowledge and background knowledge to better advise them and give them more information. So when you look at aviation insurance, aviation insurance is also commercial lines. You don't need to learn this for exam, but it's good to know it. Aviation insurance is an insurance coverage geared specifically to the operation of aircraft, aeroplanes, helicopters, microlights, etc., and the risks involved in aviation. Aviation insurance policies are distinctly, sorry for my tongue twister there, distinctly different from those for other areas of transportation and tend to incorporate aviation terminology as well as terminology, limits, and clauses specific to aviation insurance. Aviation insurance is divided into several types of insurance coverage available, namely, this is the type of insurance we're going to look at and discuss now in class 1.3. We're going to look at public liability insurance. It's like third party, other people. Passenger liability insurance, combined single limit CSL insurance, ground risk hull insurance not in motion. That is when the airplanes are standing on the ground, so they are not in motion. You're going to look at ground risk hull insurance in motion when they're taxiing. You know, for those people who never flew in an airplane, once you're inside the airplane, then it must drive to the runway where it's going to take off, and they call that taxiing. Even when a plane lands, and now must get off the runway towards the place where the airport, or if it's a small aircraft, to the side where it's going to park. Then that they call that taxiing. In-flight insurance, so when the aeroplane is in flight, the employee insurance, like the big SIL and the big commercial aeroplanes, they've got staff, your waiters, and so on in the planes. Also, they've got the pilots who's employees, the service personnel, etc., and also goods in transit, the things that you load into the big aircrafts, all your goods, etc. So we're going to look at all these kinds of insurance. So when you look at liability insurance, and you can maybe make a note for you, um, make a note there, it's third party, okay, so that you know this is all about third party. The coverage often referred to as, you see there it says, third party liability covers aircraft owners for damage that their aircraft does to a third party's property, such as houses, cars, crops, airport facilities, and other aircraft struck in a collision. This will might, for instance, be a pilot makes an emergency landing and he lands into a farmer's crop fields and he destroys all the crops. Now that farmer cannot sell his crops because they are destroyed. That farmer has got a loss of income. He might not be able to pay his farm the bond at the bank for the farm because he's got no crops to sell, um, and he might lose his farm. So he needs to be reimbursed. So then they've got insurance that will pay the damages. Also, the pilot might do a emergency landing on the freeway, and then there's some cars involved in. As they see the airplane, they stop and they ram into each other, and there's a big collision on the highway because of this airplane made the emergency landing, and which happened in the past. So then all these people also need to be reimbursed. So you see the second bullet, it does not provide coverage for damage to the insured aircraft itself or coverage for passengers insured inside the insurance aircraft. There is other insurance for that, which we are going to look at now. It's the third party, somebody else. Okay, it's called damage. And also they said airport facilities. So the airplane might struck a building, or it might struck another aircraft. So, which also happens, one aircraft is, your aircraft is parked and another one is going past it, and the one wing tipped the other wing, and now the wings are broken off. Imagine you've got the airplane that's standing still, and because of another airplane, now your airplane's lost its one wing. Who must pay for that? So the other aircraft who caused the damage, they must pay you the damage to your aircraft as the third party. All right. Then we look at passenger liability insurance. Passenger liability protects the passengers riding in the accident aircraft who are injured or killed. In many countries, this coverage is mandatory only for commercial or large aircraft. Coverage is often sold on a per seat basis with a specified limit for each passenger seat. So when you buy your airplane tickets, they will tell you, okay, this aircraft, let's say, for instance, got 500 seats. The premium for insurance, in-flight insurance, is X amount, and they take that amount and divide it by the 500 seats. So each ticket must pay that portion for the insurance. So whenever you buy a ticket for an airplane, you're also paying part of the insurance. A combined single limit. Now that word says it all. It's a combination where you pay where there's a single limit. So CSR coverage combines that public liability, that third party we talked about, and the passenger liability coverage into a single coverage with a single overall limit per accident. So a CSL combined single limit takes a public liability, the third party, for the farmer's crops and passenger liability, makes it a single coverage with a single overall limit per accident. This type of coverage provides more flexibility in paying claims for liability, especially if passengers are injured but little damage is done to third party property on the ground. Then you look at ground risk, hull insurance, not in motion. So this is where the aeroplane is not in motion. It's standing still at the airport, or it's standing still in the hangars where it needs to be serviced. So this provides coverage for the insured aircraft against damage when it is on the ground and not in motion. This would provide protection for the aircraft for such events as fire or theft, vandalism, floods, mudslides, animal damage, wind or hailstorms, hangar collapse, or for uninsured vehicles or aircraft striking the aircraft. So it might be inside the hangar where it needs to be serviced, and because of strong winds and hailstorms or floods, that the hangar collapse on top of the aircraft and the aircraft is damaged. Or the smaller aircraft, the guys that fly in Botswana to all the game lodges. There were stories about elephants that scratch their backs or their sides against the aeroplanes that stands there in the open field, and then sometimes the elephant will have a look at the aircraft and just give it a nudge with his tusk and put the tusk right through the aircraft, through the pilot seat, and they damage that whole hull while the aircraft is not in motion. Then, if it's your airplane, somebody has to pay for it. So that insurance cover that. Then you look at ground risk hull insurance in motion. So when it's taxiing. So for those of you who never flew, taxiing is when you board the airplane, you go to they say to our Tambo or any other airport, you get into the airplane, but the airplane now is reversing and then it's taxiing. It's driving towards the runway where it's going to take off. So that action from when it's leaving the airport and is driving towards the runway, that's taxiing. So so taxiing is not when you're flying, it's from the airport to the runway. And from the runway, if it landed, it's taxiing back to the airport. So this coverage is similar to ground risk hull insurance, not in motion, but provides coverage while the aircraft is taxiing, but not while taking off or landing. So normally coverage ceases at the start of the takeoff roll and is enforced only once the aircraft has completed its subsequent landing. So yes, that's what they say. When the aircraft is taxiing with the passengers to go to the runway to take off, and the moment it takes off, this insurance stops. It flies from point A to point B, and only when it lands on the other side and it's taxiing from that runway back to the airport, then the cover kicks in automatically again. In-flight insurance. In-flight coverage protects an insured aircraft against damage during all phases of flights and ground operation, including while parked or stored. So this includes everything. Yeah, this insurance it covers when it's parked, when it's taxiing, when it's flying. It covers everything. So naturally, this is more expensive than not in motion coverage, since most aircraft are damaged while in motion. So this option is also there. If you don't want to have the other insurance options, not in motion, you want everything. Since he's standing still and taxiing and flying, it is higher risk, more damages occur while in motion, but it is an option to take that insurance option as well. Employee insurance, personal accident cover for all individuals, me and you buying the plane tickets and the employees on the airplane, like the pilots, the co-pilots, the pilot engineer, the waitress or waitresses, all of them. A personal accident policy is designed to provide employees with benefits for accidental death, permanent total disability, income protection, and their medical expenses. The cover can be structured to include benefits for serious illness as well. So the benefits provided under the policy are usually linked to the employee's annual salary with the death, and permanent total disability benefits, a multiple of the annual salary, for example, three times the annual salary. So should the employee maybe die, they can look at giving the employee's annual salary with death, maybe to the spouse or any other person, or if they are permanent, total disabled, they can get the disability benefits of multiple of the annual salary. For instance, For example, they can get up to 3 times their annual salary because they've been disabled. Goods in transit insurance. So goods in transit insurance provide financial protection against the loss of or the damage to goods while in transit, whether due to accidental damage or theft. Cover can be purchased for raw materials, goods being manufactured or traded, and goods belonging to a third party. The cover varies from insurer to insurer and can be structured to suit the insured's pocket. Regulation driving demand for goods in transit cover. An amendment to the National Road Traffic Regulations was published in the Government Gazette on 31 October 2014, requiring that freight haulers and transport companies provide written evidence that both their vehicles and goods in transit are insured. So they must give proof that goods in transit, whichever they load onto their vehicles, and the vehicles are both insured. Regulation 330D now states that the consignor or consignee to insure goods to be carried on a motor vehicle and the motor vehicle itself needs to be insured. A consignor or consignee of goods shall not transport goods on a public road or accept goods unless, very important, they are not allowed to transport goods on public roads unless such transportation is fully insured for damages that can occur as a result of an accident. In terms of the regulations to the consignor or consignee, they are juristic entities dispatching or receiving more than 500 tons of goods in a month by road. And that's the end of part one. I hope everything made sense to you. If you've got any questions, please see my email there, yaku@ilearn.co.za, and I will gladly help and assist you by answering your questions.